Thanks everyone for joining in for this session. I think it's a very relevant session in terms of what we're seeing in the markets today. So I'm sure all of you will benefit immensely from the discussions, from the thoughts that our panelists are going to share with all of us today. As for some of the participants who have attended our webinars in the past, you know the format, how the format goes, but we have quite a few new members today. So for their benefit, I'll just quickly explain how the discussion will go today. We are going to focus on Q1, what happened in the markets, what are the view on different asset classes. We'll get a discussion around that. There's a risk-on conversation happening around in the market as well. So provide more clarity there as well. And lastly, but not the least, we are also going to discuss how investors can really manage their portfolios, how can they really position themselves to benefit from what's happening in the market or really manage the risks they have in the portfolio. Subsequently, we are going to open up for Q&A. For the Q&A is typically for the last 15-20 minutes, but you can always send in your questions while the discussion is on through the Q&A button that we have on the Zoom. So you can always keep sending us your questions. And we generally keep it a candid conversation. If you feel a question is relevant, our panelists are free to really take on the question and respond to that query while we're in the session. So that's going to be a general flow for today's session. I would like to introduce our panelists now that we have on the session. But before I do that, just quick disclaimer: this is not an advice. This is just an information to educate you, to get views from both the side of the aisle, so to say, where you can make your own decisions as to what suits best for your portfolio. As we have always maintained in Kristal webinars, we try to get a diverse opinion, a view on the markets. We resist from saying that there's a definitive position of the house. We try to give both the views so that investors, wealth planners, financial advisors can really decide what suits their client the best. Moving on to our introduction to our speakers, really delighted to have a very experienced and a young panel today on a session. I'll first like to invite our guest panelist, Ashwin Murthy. He's a very illustrious speaker person. Ashwin is the founder and chief investment officer at AVM Capital. He launched the AVM Global Opportunity Fund in 2016. It's a macro investment strategy with an established track record, delivering attractive risk-adjusted returns. He began his career in fixed income at UBS, where he was involved in trading complex derivatives across fixed income spectrums, a journey that involved working in 4 different teams across Singapore, London, and Zurich, a very strong global experience. He then moved to Hong Kong to lead the FX options team at Natix, earning them an accolade of the second best FX solution house in Asia in 2015. Ashwin was awarded a scholarship by the Singapore Public Service Commission to study engineering in France. He graduated with a diploma, a Master of Science in Engineering. Sorry, I'm not good at French, so I'll use the English version of it. Master of Science in Engineering from École Centrale, Paris, and received Bourse d'Excellence, I feel, from the Ministry of Foreign Affairs in France. Ashwin then went on to obtain a Master of Science in Financial Engineering from Columbia University. I think Ashwin clearly would be the most honored and the most illustrious, kind of academically illustrious person that we have on the panel so far. But just moving on to our regular members of the panel. Thomas, as all of you know, heads the trading and asset management team at Kristal. He is the person whose thoughts define what you see in the insights that we share with you, with the insights that our algo kind of delivers through its accumulation. So Thomas kind of shapes a lot of thought that gets delivered to our clients and wealth managers from Kristal. He has more than 25 years of experience and has worked with names like Bank of Austria and JP Morgan. Ankit Agrawal, who's the third panelist of the team, is the youngest member to join the panel. He leads the investment advisory desk at Kristal, and he manages various activities like portfolio management and advises large portfolios that we have for our clients in India and Asia. He has over 9 years of experience with multi-asset investments and global markets. Before Kristal, he was with Goldman Sachs. Ankit is an MBA from IIM Indore and is a computer science engineer from BITS Pilani. So I think that's a quick introduction for all the panelists. I hope that would give you the confidence on the discussion we are going to embark on. So let me just tell you, I think just going back to the agenda, and I think all the panelists, thanks again, everyone, for finding time to join in. Thanks, Ashwin, Ankit, and Thomas. Really pleasure to have you with us. We are going to keep this discussion very focused and targeted. I think the first thing is that, we all know that the kind of geopolitical tensions that are there, and all the clients and advisors really trying to figure out what's happened in the market, how to really make sense of what's happened in Q1. I think Q1 was a quarter of surprises, and I think nobody expected the world to be in a place that we are today. So we are going to talk about the geopolitical risk that we have today, and the range of issues there. How is the military conflict going to affect? And all scenarios that just added to the uncertainty. We keep reading about the Fed as well, and there's always a talk about what's going to happen next year. So I think investors are really trying to get their head around a lot of things. So with that, let me just go with, I think I'll just start with Ashwin first. Before we do that, I will just request my team at Kristal to start a quick poll so that we can kind of understand how the people have performed during turbulent times. And while people are answering, I think we can get a discussion going and people and participants can respond to this poll. So I think the first point that I would want to really understand is what happened in Q1. So Ashwin, I think my question will be to you. What do you think has been the biggest market-changing event over the past quarter, and how has the market evolved in this time? And that would be my starting question to you.
Sure. Thanks once again for having me on the panel today. I think a lot of stuff happened in Q1, as you mentioned. First and foremost, I mean, the thing on everyone's mind is the war in Ukraine, and the impact. It's sad, it's tragic. It's impact in Europe. But I don't want to talk about that event particularly today. But just the market impact has been high commodity prices. You've seen the impact of the economy in Europe. The second thing that's recently happened is lockdown in China, where we've lived through the supply chain disruptions 2 years ago. That's about to happen again, most likely. But I think the biggest market moving event this last quarter was a change in the reaction function of the Fed. Over the last 30 years, under Greenspan, under Bernanke, under Yellen, under Powell up to now, we're so used to the Fed put, where they come in to save the markets with monetary easing the minute asset prices drop. But all that changed in the first quarter of this year. Actually started towards the end of last year, where the inflation started to, it was at a high level and continues to trend higher. And central banks are now worried that, we're going to get some sort of 70s inflation scenario. So, just yesterday over the Fed minutes, they made it clear that what's going to happen over the next, I'd say 12 months is they're going to raise interest rates until they get inflation in check at the expense of growth and corporate profits. So I think this is a regime we haven't seen over the last 30 years. It's something new. And I think that was the biggest change. And I think we've seen the behavior of asset markets change as well over the last quarter.
Thanks for that, Ashwin. I think it's interesting that you say that we're trying to, the world seems to be moving backwards. Russia seems to be moving towards 19 and the West seems to be moving towards 70s. Thomas, you are 400 kilometers away from the conflict zone. What's your view? What's your emotion on how this is going to affect the various asset classes? What's your perspective?
Yeah, so as Ashwin said, I think it all boils down to central bank policy. What we are witnessing right now is, at least in my career, the fastest withdrawal of liquidity and credit availability in the market. And that is definitely a big driver going forward. So central banks tightening, we're not only factoring in the interest rate increases that have been signaled by now, but also shrinking the balance sheet of central banks that's happening. Usually you also see in these times of change that from a private sector credit availability, credit conditions are tightening. So you do see some signs happening in the US, in Europe as well. And that will have definitely a big impact on the consumption. What in Europe is the biggest talking point right now is definitely still on commodity and energy side. Um, the dependency on Russian oil and gas, especially for Germany, Austria also to some degree, of course, but and Germany being the biggest economy in the EU space, that is a big worry here. It has definitely gone out of control in terms of the worries about that, and that's I think why central banks are so aggressive with that. If you look at the Fed's mandate, the Fed has two mandates: labor markets and inflation. You saw last week non-farm payrolls and unemployment rates, which is still below 4%. There's no danger for them at that point in time. For me, the Fed has done a major policy blunder last year already. They had a golden opportunity sometime in May to July last year to start to tighten a little bit the screws in terms of monetary policy. But this narrative of transitory inflation and all these things that we have seen was a total policy error by Powell. And now we're paying the price for that. So we have to brace, unfortunately, for more volatility. I agree with Ashwin. The narrative has changed. Anybody who had any doubt about the disappearing Fed put, at least since last night, that doubt should be gone. And yeah, so that's kind of like what we have to watch out for in the coming quarters. So to sum it up, commodity inflation is still driving the markets and therefore inflation expectations, and that's impacting central bank policy and risk assets in general for the next 2 quarters at least. Siddhant, you are on mute.
I'm interesting that you kind of brought out the policy error on the Fed side. I think I think we haven't really discussed that in the last few months as much as maybe today is a good point to discuss. And we'll get to that. I'll ask Ankit to weigh in on how the clients are reacting. I think Ankit has a good view, ringside view, not a ringside view, but actually a direct view of the reaction of clients on the portfolio. So while Ankit kind of starts that, I request my team to put a second question. There's something we'd like to understand that how are you managing your portfolio right now? I mean, what's your approach in these troubling times? And as Ankit prepares, as I move the question to Ankit, and we still have a few questions, so I just request my panelist, Rajneesh, to just hold on to the questions for a little while. We'll just cover discussion, and then we'll definitely take on very relevant questions that you have posted. So Ankit, moving to you, I think why don't we take the next, try to understand the reaction to what's happening in the market from the client's perspective. How's the investors reacting? What's your view on things? And I'll let my participate in the poll in the meanwhile.
Sure. Happy to. And thank you again for having me on the panel. Look, before we get to clients' reaction, have to say two things. One is that this is an unprecedented regime. And I know, like, we often discuss parallels with post-war era of 1940s or 1970s as well. And there are quite a few similarities, but also there are quite a few differences that exist from those periods. And most of us have never encountered a pandemic in our lifetime. So the playbook of how the economy behaves coming out of a pandemic simply does not exist. This is evident if you look at disparity in terms of fund manager and trading community views on asset classes. And it is also reflected in somewhat the reaction function of our clients over the last quarter. Broadly, I would say there are two categories. One is that category of clients who have been riding the wave of euphoria coming from the reopening, and they were sitting on healthy profits coming into 2022. And all of a sudden they realize that the world has changed and they have cut risk significantly in their portfolios. The second category, I would call them as more patient and seasoned investors. These people's reaction function is more similar to what you observe in the institutional community, where they look at sell-offs as an opportunity to accumulate high quality exposure. So these are clients who often reach out to us on every 5 to 6% sell-off. That look, I am looking to get into this high quality mega cap stock or a fixed income or an equity exposure. Broadly, if I glean out 2 to 3 common themes, one is that we are observing that clients are moving towards higher quality exposures and they are trying to avoid riskier pockets, like let's say smaller caps of the equity market or high yield or leveraged fixed income funds. We are also observing that clients are rotating a little bit towards more value-oriented exposure. So we have seen things like financials, energy sector, and even commodities start to come into portfolios, where typically portfolios have been very tech-heavy. If you look at the last 2 years, most clients have been late to this commodity bandwagon, but nevertheless, people who also started to invest in Q1 are still sitting on a small amount of profits over there. And finally, I would say there is an increased focus on alternatives as a space, where we talk about multi-asset hedge funds, similar to what Ashwin runs at AVM, but also a couple of others like arbitrage funds, live settlement funds, things where you don't have to make active calls on the market, and you basically rely on the fund manager to make those calls for you, and they generally provide you uncorrelated type of returns.
Thanks for that. I think that was quite succinct. And I'll take the discussion a little deeper into these asset classes. So, we're talking about commodities, and everybody kind of feels that the price is rising there, and it's a good asset class. But actually, I think equities and fixed income, there's still a lot of questions around it. Stay status quo, stay where you are, or still delve into it. I would like to bring you into the conversation on the equities and fixed income side. How would you suggest we can really look at these asset classes and visit these markets?
Yeah, so I think, we coming back to the change in reaction function of the Fed. So what they're doing is they need to tighten financial conditions. What that means is, bring the interest rates up and bring the inflation adjusted interest rates higher, so that valuations in equities and commodities start to come down and growth starts to cool and corporate profits start to go down, right? That's the only way you're going to reduce demand and bring inflation down. So with that in mind, I guess for us in the firm, we think equities have hit their all-time highs at the end of last year. You've had this, as Ankit mentioned, the last 2 years of euphoric. The returns that were made in the equity markets in particular were outsized over 2 years. And even if you go back the last 5 years, they'd be pretty good. But with interest rates looking, I wouldn't be surprised if we see 3% within a year. Once you get to these levels pretty quickly, the first thing that happens is valuations change. So if the equity markets were trading at a multiple of 20, they're probably going to come down to 16. If credit spreads used to be at 120, they're probably going to be at 180. That's just the new normal that we need to be prepared for. That's how it used to be probably in 2010 to 2015. So just putting that in perspective, we are taking a view that equities are going to be on a downdraft, depending on which region. We think Europe will probably be impacted first because the higher rates and higher oil prices have a real bad effect on Europe compared to the US, for example. But we think the US won't be spared. There's a lot of talk about soft landing. I think it's unfortunate this time around. The only way to bring inflation down, in our view, is that they need to cool down the labor market. And that means bringing unemployment up. And whenever that happens, I think they've looked at all the recessions in past history. Whenever unemployment goes up by about 0.5%, there's going to be a recession. So our view is that, the US markets as well are probably going to get into a recession next year, and that equity markets will start sliding as well. So with that in mind, I think the equity markets, if you are exposed to that, if you need exposure in equities, I'd like to say after 5 years of great returns, let's exercise some financial prudence and go into the safer part of the markets, defensive. So you can look at utilities, you can look at staples, which tend to outperform in this late stage of the cycle. And you could also look at energy at this point in time, because structurally there is a lot of demand and so has supply chain disruptions. So I think these three areas probably on the equity side. On the fixed income side, there's one place to hide. And I always, at this stage of the cycle, when interest rates have gone up, you want to stay in short dated investment grade bonds. That should, you're getting decent yields now. Probably 2 years ago, you were getting less than 1%. Now you're getting close to 4%. That's where you want to hide. They should do well and give you a good cushion over the next 12 to 18 months.
Thanks for that. I think I just got reminded of what Warren Buffett said, that he doesn't get why people are investing in long-term treasuries, right? He just doesn't get it. Before I come to Thomas on the commodity side, I'll go to Ankit to share his views on the equities things. Any aspects that you would like to add to what Ashwin just mentioned?
Sure. Thanks, Siddharth. And I broadly agree with whatever Ashwin has said. And I think we are definitely in the latter stages of the cycle, and we are going to see a rollover of the cycle. it's still out there whether when does that rollover happen, and trying to time recession is not a worthwhile exercise for anyone. When we look at macroeconomic growth indicators, there are quite a few of them which are already indicating recessionary levels. So when you look at things like consumer sentiment in the US or even credit impulse across the developed countries, we are starting to see recessionary signals over there. However, certain indicators are still not flashing recessionary signs, and they are quite healthy. So when you look at composite PMIs across the developed world, they are still in the late 50s or early 60s region, which is not typical of an imminent recession. Similarly, when you look at OECD growth estimates across most developed economies as of today, or for global GDP growth as well, it's around 3.5% to 4%, which is almost 1.5% to 2% above trend growth levels. So again, it's a mixed bag. We don't think that a recession is imminent in the near term, but we are certainly in the latter stages of the cycle. Similarly, when we look at valuations or positioning in equity markets as of today, not seeing a lot of euphoria or stretch, or the positioning doesn't look stretched right now compared to history. So some bit of pain is already being priced in, and investors are being a little wary. Similarly, when we look at earnings, even though earnings tend to be a lagging indicator because generally analysts are slow in revising them down, even over the last 1 month, we have seen earnings get upgraded in certain sectors, especially the ones which Ashwin mentioned. So things like energy, high quality tech are still seeing a bit of positive earnings upgrades. So we do think that immediately in the near term, there might be some more upside in equities. I'm not sure whether we retest the highs that we saw in the last year, but definitely not calling for an equity market which is going to return high double digit or even mid double digits. It could be single digits, low or high single digits, something like that. The other thing I would like to say is, because we get a lot of questions and there is a lot of commentary out there around yield curve inversion, that the yield curve is starting to invert and that is typically a recession indicator. We agree with that. 100% of the times in the past, a yield curve inversion has been followed by a recession. But it's also important to remember that that recession has hit about 6 to 18 months following a yield curve inversion. And from the yield curve inversion to the time you have gone into a recession, equity markets have delivered somewhere in the range of mid single digits to mid double digit kind of returns. So would say that investors should still stay invested in equities. However, it is very important to have your late cycle playbook ready. So would say that investors should probably rotate out of these small cap and higher or high riskier pockets of the equity market and go into things which are safer, which are quality mega cap companies, which tend to do well during these periods of time. Similarly, in portfolios where there is a lot of tech exposure, adding some bit of value-oriented exposures, things that work during inflationary environments, is like a wise thing to do, because you want to position for the environment where actually oil prices go up to $150 or inflation really shoots through the roof, right? And then on the fixed income side, 100% agree with what Ashwin has said. Like we want to avoid riskier pockets of fixed income at 3%. If treasury yields actually go to around 3% and you are getting around whatever, say 3.5% to 4% on shorter dated investment grade credit today, that is quite valuable in today's environment. And I will just close with one last point around high yield credit. I know that today high yield credit probably gives you a lot of yield, but would also say that high yield credit is typically one of the first places where you start to experience signs of stress when the economy starts to roll over. And a typical credit ETF has two components. One is credit spread and the second is the risk-free rate. Credit spreads are normally correlated with equities. So, and they generally tend to underperform equities going into a recession on a risk-adjusted basis. So in portfolios, it is worthwhile to look at equity plus some high quality IG or government bond exposure rather than go into riskier pockets of credit as of today.
Thanks for that. I think thanks for sharing some little directions there. We seem to have kind of moved to the next point already, where we are giving a kind of some viewpoints on how to really position the portfolios. But I would like to bring Thomas in on the commodities side. Thomas, if you would just provide more insight and information around how to really What's your view on this asset class, and how do you think commodities can really play in the portfolio right now?
Yeah, well, it's a big topic. We can probably fill a webinar by itself with that. So let me try to squeeze a few important points into the next 3 to 5 minutes. Ashwin said in his introduction with supply shocks that have been happening, that's exactly what we are going through right now in the commodity sector. So we are witnessing the second supply shock in a matter of 3 years. First COVID-19, now Russia. Russia has been supplying the world market with around 8 million barrels per day in the past, on a production of 92 million, which was based on December 21 numbers. That is similar to what Iranian oil production was in 1979, when you had the revolution in Iran as a percentage share of the global world production. At the moment, Europeans are still taking Russian energy. Political situation, I'm not a political analyst. I don't dare to make any comments of that one, but it has become very unpredictable. Therefore, there is a possibility for a shock that is similar to what we have seen in the 79 period. So therefore, I think all this talk about stagflation and sustained high inflation, double-digit inflation, is warranted, and people should definitely be concerned about that. The thing with commodities is they work until they don't in such a scenario. Sounds a little bit stupid, but unfortunately it is what it is. Ankit has been mentioning recession signaling, and that's exactly what's going to happen with the Fed moving aggressively. And then you will see, especially in industrial metals, a drop-off of demand, and therefore prices might come down sharply again. Same also for energy consumption, which is said to be going lower. I personally are focused on two things here. One is energy, and the second one is agricultural. So on top of the energy supply that is coming from Russia, the production in terms of wheat and fertilizer that has come out of Russia and Ukraine has been substantial for the global market, and has been a very big price driver as well for food price inflation. So keep an eye out for that as well. We have already fertilizer shortages globally. You also need substantial amount of gas to produce certain types of fertilizers. And we've noted in certain pockets dramatic price increases. For example, I was looking at fertilizer prices in the Asian region because we were writing an article for a Asian financial publication there. In 2020, fertilizer prices doubled already in Thailand. In 21, another 100% increase. And we are now for nitrogen fertilizer at a price of about $1,000 per ton in Thailand. Thailand is one of the biggest rice producers in Southeast Asia. And that is more than twice the price of 1 ton of rice. I mean, you don't need 1 ton of fertilizer to produce 1 ton of rice. But if you translate it with the fertilizer ratios that you have, you can estimate roughly that prices for very important grains are going to rise anywhere around 10 to 15% in 2022. And that's, I think, at the moment, not really visible in inflation numbers in Asia. And then also don't forget, and this sounds a little bit gloomy, and I hope I don't make people too depressive here, but these are things that keep me up at night. These essentials, energy, how you heat your house, how do you cook your meals, where do you get this fuel from, how do you feed your family? We have seen this in history over and over, and I sound a little bit like Ray Dalio probably here, but this is the playbook for political instability. Yeah? So we're keeping an eye very closely on certain emerging market countries. You see already Sri Lanka situation is worsening dramatically. In Egypt as well. 2011, the Arab Spring Revolution was mainly driven by bread price increases. Yeah, so that's another risk factor that plays in here, and that's why it's important to watch commodities. Even I wouldn't recommend at this point in time, after these price increases that we have seen, to increase massively your allocation to commodities. Yeah, it should be in the overall asset allocation that we have in the portfolio. but it is important to watch these markets for signals what else might be unraveling in other pockets of the market.
No, thanks for that. So echo there. No, Thomas, you're right. I think you're not sounding negative here. Maybe it's just a little less light at your end, that you look a little darker on the screen. But otherwise, I think what has been really remarkable about this conflict is that the global ramification. It's not that there were not conflicts prior to this in other parts of the world, but the fact that how this one conflict has impact not just in the Western world but even Asia. Right? A very simple example: there's a regime change happening in Pakistan because the Prime Minister seems to have visited Russia. Right? So this, so it's just the implication of this one conflict across the globe is what really is the scary part. And I know that I think the next question, that point on the agenda that we wanted to discuss was how should really the investors position their portfolios, and I think we've discussed that in a bit. So I'll use this round more as a kind of summarize what you discussed, to get a little more takeaway points for the participants. So I think we have a question on what's the best way forward. I mean, this is a poll for the panelists. What would be your take? We take a call on the market movements and gamble, or we sit out through these turbulent times while holding on to cash, buy and hold, or evaluate the change in the intrinsic value of the investment markets and invest in value sectors. So I think there's a question to, why don't I take to Ashwin? Ashwin, what would you take in these options? What are it's a multiple choice, so you don't have to pick one. You can select more than one. What would be your choices?
Yeah, so I think you want to bring down your risk levels in this period of uncertainty. So, something I mentioned earlier. So, if you were investing in high yield bonds, maybe bring that to shorter dated investment grade bonds. If you were investing in tech, maybe start shifting that towards staples and utilities, which, even though it's a bear market, those asset classes can continue rising, right? So I think the mindset has to change. While you're chasing aggressive returns over the last 2 to 3 years, the next 12 to 18 months are going to be very challenging because financial conditions are going to tighten. So I would say during this period, stick to low volatility sort of strategies, and that will be the front end of the fixed income spectrum and the more defensive sides of the equity market.
Thanks. Ankit, your choices A, B, C, D, what will you pick?
Yeah, so I would almost echo what Ashwin is saying. Stay invested in equities, but do take a hard look at your holdings and consolidate where you think are the riskier pockets. Rotation into sectors which work during inflationary or low growth regimes. So no need to completely give up on high quality tech, but do start to look at sectors like energy and all. And I know a lot of investors frequently ask this, that is it okay to chase right now in commodities? Well, if you look at simply the energy sector per se, its underperformance versus even something like oil has been massive over the last decade or so. So we do think that it could spur an investment into more traditional energy pockets, and energy as a sector might do okay. Similarly, high quality fixed income. So I won't just repeat whatever Ashwin said over there. Alternatives, I think, is an interesting space to look at. Basically, you want to have a section of your portfolio where you don't have to manage it day in and day out. You basically let a fund manager who can manage it both from the long and short side of things, and rely on him to make those directional calls. So I think that's something which can be extremely valuable during this time of a setup. I would say investors broadly need to be cognizant of two important things. One is that we have to understand that our return expectations and Sharpe ratios are not going to be the same that we have seen in the last 3 years. So over the last 12 months, lower your expectations accordingly. Second is we need to go back to basics on asset allocation. Please talk to your advisors about the role of multiple asset classes in your portfolio and how they typically behave during these different kind of environments. So according to me, it is time to play more defense than offense, but it's not like sounding the alarm where you just need to raise piles of cash and sit on the sidelines.
So thanks for that. Okay, then just for the participant, we are just very close to getting started with the Q&A, and we'll take these questions. But before I do that, I'll go to Thomas. The one question now, in the age of when there's a word of Deglobalization is the word being talked about. There is, from the news that people are reading about the global markets, there is a bias to stay in their domestic market, something that you're more familiar with. So how do you set, I mean, if the question was to investor that how do you set yourself for future success and build a truly sustainable portfolio? I mean, the options that we have, and what would you really recommend? There's a geographical diversification, safe haven. What are the options that you would want to really build a sustainable portfolio and really manage these geopolitical risks? And this question is to you, Thomas, because you are really good at managing risks. So I want you to weigh in on this question.
Yeah, I mean, over and on top of what has been mentioned already, I also wouldn't dismiss the role that certain stores of values can play in a portfolio. So gold, definitely one of the things. I might be a little bit of a contrarian to my other fellow panelists here, but I do think that the negative real rates environment is here to stay, because I see inflation just rising faster than interest rates at that point in time, which should be supportive of gold. Also, if you look at the price of gold adjusted for inflation in this 79, 80s area, has been the best performing assets in the market. Yeah, we are still at levels way below the highs that we have seen in February when Russia invaded. There's some upside here. Other precious metals are also not to be dismissed. I mentioned the energy situation. You do have a big industrial application for silver in solar panels, for platinum in battery technology. So if you have this multi-year trend for renewable energy, I think these are interesting assets as well, which act as a store of value. Plus, there's a fundamental or secular trend towards more demand in the long run. That's one thing. Second thing is keep a cash buffer. Similar to what Ankit said, I mean, it's not to go 100% into cash, but it's good to have some cash on the sidelines, and also shorter dated investment grade or even US Treasury, where you can hide and ride out a volatile period, what we expect to be the next 6 to 12 months, is not a bad thing to be ready and deploy it. The other thing is, and for all the attendants who are clients of Kristal, reach out to your RMs. We have a number of strategies on the platform that also give some downside convexity. So convexity meaning that it's not a linear profile if the market sells off, but you're having a little bit of a buffer and hedge components in it, as well as market neutral strategies in this environment. That's kind of like the allocations that I would go for. Yeah. We also have one question, and maybe it fits into this into that question that you had. Was one question that I saw in the Q&A about the role of REITs in a portfolio. REITs have been also performing very well over the last month, in March in particular, and that is also in the long run, given the underlying assets being real estate in these portfolios or in this asset class, often rents are tied to inflation numbers as well. So there is a good transmission effect of high inflation transmits into higher rents. Therefore, the units or the unit profit remains stable on the REIT side. So that is still also an asset class I'm positive on. Although one thing that's important to be careful on the leverage ratio as well, because some REITs have a higher leverage applied, which means as rates are going up, they will be more exposed and it's eating into the profits eventually. But REITs with low leverage ratios and steady portfolios are also a good place to go.
I think you have echoed this sentiment even in the recent insights that we have published on the REIT side. We are in the last 20 minutes of the session, so I would say, given the number of questions that we have, I think we'll try to delve into the questions that have been posted to her. And I would typically go chronologically, but I think there's one question that is directed to Ashwin, so I'll start with that. There's a question to you, Ashwin, from Mr. Rajneesh. She says, what do you see as a feasible return target for AVM Global Fund in 2022-23, given the entirety of the issues ahead and possible recession in 23? and cause of, as the Fed looks to control inflation and cause collateral damage for growth. So I think I'll just take with that question and open up the floor for Q&A. Ashwin, yeah.
Sure. The fund is I would say, is an absolute return fund. So we're not correlated to stocks. We're not correlated to bonds. So, it's been through, over the last 5 years, I think we've been through 3 bull markets and 3 bear markets, which is unprecedented. So the strategy doesn't change. We're targeting 10 to 15% returns for investors. We've had the least volatile period in 2017 where, we generated 19%. I think the first 5 months of COVID were the most volatile. And during those 5 months, we were up 10% up every month. But, so I can't promise returns or anything, as no one would. But I think, the strategy is nimble. We're very forward looking. The way we think about markets is not what's happening today, next week, or the next month. It's about where we're going to land over the next 3 to 12 months, and we start to position for it. So I think that's why now our view of the market is that in a year's time, if we were sitting here and talking to each other, we'd be facing probably a drop in profits and a recession. So our job is to position the portfolio to be at the right place over the next 3 to 12 months. So I think nothing's changed as a strategy. You can just take a look at the historical returns, and that should give you an idea of where we should land.
Thanks for that. I hope that answered the question. Now, Thomas, there are a couple of very technical questions that were posted by Mr. Rajneesh Agrawal again. If you look at the top 3, so I'll kind of pull you in to take the first question on what probability would you associate with risk on, risk off, and over what time horizon? I don't know if there's a simple answer to that.
Yeah, look, at the moment, I see the risk more skewed to the downside. Probability, hard to say, it's probably 50-50. As Ankit has been saying, I think Ankit has been responding to the question quite well we have seen this in the past when while the market is signaling recession, but equities still continue to rise. This is like a little bit of ripples in a pond, that keeps to go on for some time. It might be like the market move since the 14th of March, this rally that we have seen off the lows. Nobody really understands it. Yeah, I think it's a fair bit of short covering that has been happening, but it doesn't make sense if you look at it. Nothing really has changed to that much to the better. But it is what it is. At the moment, what we have been saying just at the beginning of this week, our investment committee, we got together, we analyzed everything from a technical perspective and fundamental perspective. I would say on the equity side, up until last night, the trend was still intact, or it is sort of like still intact. We're reaching some important support levels in the S&P 500, but there is sort of the big downside target here is the 3,600. And upside, we can retest the new high or the highs from end of last year as well. It's more of a difficult question as to what are the sectors that we are going into. One thing that I think generally is that the entire passive investment trends that we have seen over the last 15, 20 years, that will be seriously challenged. Because that's going to impact a fair amount. So it pays off in this environment to be, I would say, to take your picks carefully and look at a active portfolio management, or at least some portfolio measures to have some downside protection in there.
Thanks for that. And we have a couple of questions. I'm going to skip because some of these questions we have kind of answered during our session. So I'll take the question on private markets specifically, and Ashwin, if you can be on that, as a view on that, I just try to explore, kind of pick your brain on that. So the question is, what is the impact of all what's we're seeing on the selling off in the Nasdaq market on the private market versions? Are they getting more reasonable, do you think, or does the unlisted space will continue to have better value than the listed? And I'll take both Ashwin and Ankit on this one.
Yeah, I don't mind taking a stab, and this is not my specialization, but I think one thing we've noticed is with the sell-off in the Nasdaq, it's been difficult for private companies to come to the market with IPOs because of the demand. So I think that's one trend that might stay for a while. unless markets recover, which I don't expect. So I don't expect too many private companies coming to the market very quickly, like we saw over the last 2 years. Yeah, that's what I can add on this.
No, I think well said. Ankit, question directed to you. How do you see? I think you'll be getting this question from a lot of clients at Kristal. So what's your assessment?
Yeah, again, like not an expert on private markets and not the best person to speak on it, but I'll just give my 2 cents. And this is something which I'm just saying from empirical observation from a couple of recent instances, is that I don't think that private markets today look cheaper compared to public markets. They are at least as expensive as public markets are, might be a little bit more, because there's been a lot of funding that has gone into these. And we have seen also a couple of companies struggle when they have come to the IPO market. So one thing is that I do agree with Ashwin that the pace of coming for IPO might slow down. And the second is that some companies which have come for IPOs, not just in India domestic markets, but abroad as well, have struggled in the first 4 to 5 months. It's because as they have opened their financial statements to the investor community, they have taken a bit of beating. This is not to say that those are not good companies. It's just that there might be a little bit of a step down when this happens. But again, like, please take this with a pinch of salt as well.
No, I think salt is also getting expensive, so you can only afford a pinch of salt as things are going. But I would like to take the question on China equities. Thomas, there's one question that has really come, and we have really talking about China more positively in our insight. So I'll start this question with you, and I'll also get Ashwin on this. What's the view in China equities? How do you think this looks as compared to the global market? So, Thomas.
Yeah, the China equities is not an easy one. We have gone already through about 1.5 years of bear market in China on the back of crackdown on tech companies and the strains that we see in the real estate sector. The PBOC is actually, or the People's Bank of China, is one of the few central banks globally that is aggressively easing monetary policy, given the domestic impact that we have. But, and there's always a but with that, the current situation on a geopolitical side and the shortage in certain commodities is impacting China over and above due to the reliance on energy and also the reliance on food imports and fertilizer imports, etc. So China is not able to have enough energy to keep the lights on by themselves. They have not enough food to feed the people by themselves. They rely on external factors. And that's a big risk for China. I would say a month ago, I was fairly, or 1.5 months ago, I was fairly bullish on China. I thought that we are near the bottom. It's always hard to call absolute bottom. I think on a relative perspective, given that we have seen already 1.5 years of repricing, China, the benefit that China has is we are at a lower starting level than US stocks or European stocks, which are near all-time highs. So looking at it from a relative perspective, China does look definitely cheaper than the US, but there is going to be macro political or macroeconomic headwinds that China is going to face like everybody else. Yeah, that doesn't make it a clear-cut case yet. Yeah, but overall, look, some of the companies in China, I find them extremely cheap. Managing this portfolio for renewable energy or theme on renewable energy, food sector, etc., water technology, valuations that you see there, and if you put it in context with the balance sheets, although I always take this with a pinch of salt when it comes to Chinese numbers, but they do come from a very low valuation perspective. So on a relative basis, I do prefer China over Europe, for example, at that stage. Yeah.
Thanks for that. Ashwin, I think there are 2 questions that I'll pose to you, but before I do that, do you have any alternate view on China?
Yeah, maybe I'll just add it from the macro lens. What we're seeing is, I think China is trying to get 5.5% growth this year. And I see that being quite highly problematic at this point in time. One, they have a zero COVID strategy. So, with Shanghai in lockdown now, just putting that alone is going to make this very difficult. Probably going to be closer to 4.5 maximum. And then you have the crackdown on the property sector. That's almost 30% of China's GDP, which is now, not growing, probably shrinking, and has led to a lot of credit problems. So, China's economy over the last 20 years has really been thriving on credit. And once you that becomes a constraint. For us, we look at it, I think it's going to be a very tall order for them to get growth back to 5.5%, unless they ease up on these property restrictions, which would not really make sense. So I don't think they're going to do that. They try to funnel a lot of fiscal stimulus into the areas that Thomas mentioned, renewables, semiconductors. But I think from that perspective, I don't think it's enough to offset the slowdown in the property sector. If you're looking at equities per se, what I like to look at generally as a macro person, you're looking at the total social financing, how much funding is going in, how easy credit is for the markets. Things are starting to improve, but I think China is trying to avoid the boom bust cycle that they've always had. So they're not going to flood the market with liquidity. If there is another interest rate cut, it might be 10 basis points. That's not going to move the needle and get us to 5.5%. So I think, while equities are cheap, I'm not sure how much upside you're going to have on a broad equity index, but perhaps if you know which sectors to invest in, sectors which are getting support from the government, that could make money.
Thanks for that. And I think we'll cover some of the disruptive technologies question, but it seems like that China needs to move from zero COVID policy to zero lockdown policy if they want to really come out of it. But two questions that I wanted to really pull you in, Ashwin, was, again, I think, so one, it was a repetitive, but this question maybe just to add more clarity. Feasible investing approach for retail investor given the complexity of picking stocks. Any quick points there? And second, again, I don't think there's an easy answer. If the US index is going to come down, how soon is it going to bounce back? So there's $1 million question, so I'll leave you to how you want to really respond to these.
Sure. The telltale side for cycles, because, as a macro trader, you're always looking at cycles. We believe history repeats. This time it's rarely different. So if you had to ask me when we think the bear market ends, it's probably when the Fed relents, right? And that's usually when it ends, because the reason things are dropping is because they're raising interest rates, they're tightening financial conditions, and they're making it difficult for people to make money, right? So all the easy money has been made. Now they're rising interest rates, labor costs have gone up, cost of commodities have gone up, your margins are shrinking. So I think the moment they come in and say, okay, we're done hiking rates, we're going to start cutting to support the economy, that's probably when you see the bottom. And that maybe not that moment itself, but maybe within a couple of months, right? So just keep that in mind. It's all about the cycle. The Fed is the one that props up asset prices, and they're the ones that deflate asset prices. So you just need to watch them to get an idea of when the bear market ends.
Again, any investing approach for retail investors, given the complexity of stock picking right now?
Yeah, I think depending on your time horizon and how you're thinking about your portfolio, I think you just have to bring down your risk levels a little bit. Perhaps during a bull market where volatility is a bit lower, you can raise your risk limits a bit. But coming into this year, the next 12 to 18 months, just get yourself exposure into stuff which is not as volatile. Make sure they're defensive. That's why I avoided using the word tech over the next 12 to 18 months, because these are the most highly valued sector in the equity markets. But stuff like staples and utilities tend to do well in stagflation. And then if you on the fixed income side, we repeated this, but just stay in the safe side of the fixed income sector, which is a short dated investment grade side.
I think clearly it looks like difficult times for Cathie Woods. The moment you want to take the word tech, I'll go to Thomas. I think Thomas, two questions for you. One, the view on the currency and disruptive technologies. You can take this question.
Yeah, so on global currencies, we looked at back as to behavior of US dollar in these high inflation scenarios, and that's very difficult to predict because the path of central bank policy is unclear in a relative basis to each other. Yeah. So for the time being, we have seen dollar coming higher on the back of Fed becoming more aggressive. Also, dollar has still, for the time being, its status as a reserve currency. Therefore, whenever you see risk-off scenarios, dollar tends to appreciate. And there's a natural shortage of dollar in the system, and that has kept this supportive. But it's also when other central banks are following suit and hike rates as well, then this effect gets diminished. So it's very difficult. There's no direct correlation between high inflation and currencies in a longer term time frame. That's kind of like what we find from a fundamental research. So no hardcore prediction for the very long run. In the meantime, I think, as I said, risk off is determining that. Yeah. And sorry, what was the second question?
The second question is about disruptive technologies, right? Blockchain.
Yeah, I mean, like Ashwin, I think stay away from companies that haven't made a penny and are just alive on the premise of growing the revenues 50% per annum, because it's not going to happen. But disruptive technologies, ultimately, I do think the way out of this disaster will be through technology innovation. It's just going to be the question when it's going to happen and where it's going to happen. Yeah. So again, I'm very happy because what I've been saying for the last 2 years, that focus on renewable energy, focus on food sustainability, focus on clean water. I think it's more than ever important. And that's, I think, where a lot of technological improvement is going to come from. So again, renewables, I think, is in a big secular cycle. There's definitely going to be another boost of investments that's going to flow into that sector. But do we need another app? I don't know. That's a little bit of a questionable thing. So I think there will be some consolidation there. Yeah.
True. Ashwin, I think we are in the last few minutes of the session. I'll pull you in for, again, your view on the currencies. I think this is especially coming from India versus US. I think the person's trying to understand that how you will take a hedge, and also the impact of the US recession on the emerging markets. So there's two questions I would like to take in the currency view and the impact on the emerging markets.
Sure. This cycle of rising rates, is slightly different from the 2018 episode. There's a rule of thumb in the markets: when interest rates in the US go up by more than 25 basis points in 1 month, emerging market currencies are going to sell off, right? This time is different because inflation was a big problem in many emerging markets last year, and they had raised interest rates much faster. And they started raising interest rates before the US started. So this time around, if you look at South Africa, you look at Mexico, many of these countries which usually see a sell-off in the currency, it did not happen because the US is playing catch-up and the interest rates there are very high. Brazil has been performing, is one of the best performing currencies this year, in fact. So I think from that perspective, I don't think you haven't seen the impact of emerging markets, but it's going to come. At some point, 65% of global debt is denominated in US dollars. Once interest rates actually get to 3%, that's going to impact a lot of the emerging market countries which have their debt denominated in US dollars. So from that perspective, looking at India, I think the hedge is obviously expensive. If you're buying dollars, it depends on which side of your hedge is, but if you're buying dollars, it's expensive, you're selling it, it's not too bad because I still get about 4% of carry selling dollars so I think you should definitely, there's no harm to hedging your US portfolio because you earn some carry hedging it. But in my view, I think the dollar is going to rally against the rupee. That's one of the, that's what we have. That's what the firm is positioned for right now. I think the balance of payments situation in India has worsened with oil going higher. I think inflation is quite high. So, while there is the RBI has built up a ton of reserves over the last 2 years to sort of smooth out any depreciation of the rupee, like what we saw last month when oil prices spiked. I think the trend is higher. So I would say we're expecting probably, the FX rate to get closer to 80 by the end of this year.
Thanks for that, Ashwin. I think we are right on the time, just net 60 minutes of the session. Got a good conversation going, great questions that we got asked today. I think one of the best questions that we've seen in the last few months of doing these sessions. So I would like to thank all the panelists for really finding time today, for joining in and sharing your viewpoints on really, really uncertain times. Ruble was rubble, now it's back again. You never know. Things are changing so fast that yes, it leads to anxiety. But as just to sum up what panelists have mentioned, it's important to stay pragmatic. It's important to prepare. It's good to talk to your advisor, talk to your relationship manager to really look at your portfolio. So with that thought, I would like to wrap up the session today. I would again thank all the participants for finding time and joining in great numbers. Again, stay positive, stay pragmatic, and do connect with our relationship managers at Kristal and advisors for better ideas. With that, thanks a lot, everyone.
Thank you.
Thanks for having us. Thanks, Razana.